Yeah. Now, the economic aspect of this, the tax bill is supposed to produce higher wages for employees, right? You know, that's a big theme. And the second one is all this offshore cash coming back to the U.S., which is not only going to be paid out to employees, but it's also going to create tremendous reinvestment in the U.S. and invigorate our manufacturing sector, grow the economy, and grow jobs. Now, you know, I've spent 2 decades working with, you know, large U.S. multinationals, you know, the ones that have the largest offshore cash balances, whose names I won't mention. I've worked with very closely over years on this. And what I would say is that what you've seen so far in a lot of these announcements, first you saw in December and January a lot of these announcements of we're going to pay a one-time bonus of $1,000, or we're going to raise wages from $10 an hour to $11 an hour for our lowest level employees. And of course, the administration has come out and said, look, it's happening even quicker than it has. Now, if you take a look at all the bonuses and the increase in wages that have been announced so far, that's 5 basis points, so 0.05% in average quarterly earnings increase. That's not even in average hourly wages, because one-time bonuses don't actually get caught up in that statistic. So that's infinitesimal, it's tiny. Now, what is actually raising wages more than that, double that amount, is actually the increases in the minimum wages that have been enacted in 18 states this year, and then they continue to go. So that actually is increased. The federal minimum wage was $7.25. The effective national minimum wage is now $9.50, and it'll go up closer to $10 over the next 2 years. So that's actually going to have a much bigger impact. The other thing that's going to have an impact is we have unemployment rate that's structurally too low. It's below the natural unemployment rate. And so at some point, if we don't allow more workers into the country, we have a shortage of employees. And you see it in, whether it's the monthly payrolls report, or whether it's job postings to workers looking for work. The fact is that we need more employees for workers. And so the idea that the reduction in the corporate tax rate is going to drive a dramatic increase in employee wages, I think is kind of a misnomer, and that's really the view of most economists as well, other than some that are supporting a very specific provision and then trying to fill into that. As far as will all this cash that's coming back, what is it going to be used for? So if you're an Apple or a Microsoft or Pfizer and suddenly have access to all this cash you couldn't have access before without paying a huge U.S. tax. So what can you do with it? You can pay it out to shareholders, right? Dividends or buybacks. You can do M&A. You can, do more capital expenditures. You can pay down debt, right? And so the reality is a lot of these companies that have had huge offshore cash problems have developed these crazy capital structures. So you put a lot of debt in the U.S., but it's really just effectively defeased by the offshore cash, knowing when you bring the cash back, you can. So some of them will pay down a little bit of debt, but it's really to right-size the capital structure. That doesn't do anything to grow the economy. Now, what you've seen as far as public announcements so far, and most of this is politically driven, is they haven't gone out and said, hey, now we got $100 billion of cash we didn't have access to, we're going to increase our buybacks by $80 billion and grow our dividend by $20 billion. Instead, what they've talked about, and many of you may have seen even Apple's, incredibly smart political announcement of $350 billion, what they've done is said things about how we're going to, invest more in the U.S. and we're going to pay more wages and create more jobs. But the reality is, if you were looking behind the curtain, or if you had been working with a lot of these companies, they're not, with a few exceptions, they're not at all materially increasing the amount of capital they're investing in the U.S. versus what they would have already done. Apple would have spent $10 billion over the next 2 years on data centers because they need to spend that. They're going to expand their retail footprint because they need to.
They
invest
haven't been capital constrained.
Right. They invest, and not yet. And
they would have been debt financed, and now they're going to be financed.
They would have been debt financed, but it's not even really debt financed because it's offset. It's effectively defeased by offshore cash. Yeah. So all it is, instead of having 125 or 140 billion of debt in the U.S. and 260 billion of cash, they might have 50 billion of debt in the U.S. and effectively no offshore cash. And the reality is that the excess capital will primarily go to return to shareholders effectively once they pay down debt that was, to the extent the cash was really just defeasing debt, it will pay down the debt. but most of it will effectively over time be returned to
That's
show.
what happened in the
isn't
Homeland
right,
Tax Act.
exactly, which isn't necessarily a
2004.
bad thing. I mean, I think it makes it makes no sense for companies to have these wacky capital structures, but you got to face the reality that all this cash is not going to come back and suddenly create a manufacturing renaissance in the United States.
Yeah. So the economic benefit that's been
Right.
alleged is not going to really there. What about the location of operations now? You know, you can bring, at least for some, can bring cash back from overseas with less costs than they had in the past.
Yes.
Oh, yeah.
It seems like you're almost incented to continue to expand overseas. You have the markets are growing around more rapidly overseas. You have the burden reduced now, it's less complex. Why would you bring back cash back here when you've been able to get the cash you need to build your plant here anyway?
There is arguably an incentive to, if you got to build another manufacturing plant, and if it's purely a tax decision, to put it somewhere in a lower tax jurisdiction than the U.S., so that, and you avoid this worldwide tax, the GILTI tax on it, and you enjoy a lower tax rate. I think the reality is that there's a lot more that goes into the decision of where to put manufacturing than the tax rates. And so lowering the U.S. corporate tax rate will be, a modest incentive for someone who's at the margin. And I think we've seen certain companies that have said, tax rate differentials are much less of a decision-making factor, and it's not the primary decision-making factor going forward of where we're going to put manufacturing. But it's like if you take a company like Apple, there's no way they can move their supply chain for making iPhones to the U.S. It's just impossible. You got all the suppliers over there. You got the whole supply chain. You got all the workers. You're not going to find workers who are going to, work 60 hours a week for, $1, $2 an hour. But even if you could find the workers who are willing to pay more, you don't have the whole supply chain of all the parts and components. And so the idea that having a lower U.S. tax rate is going to suddenly shift manufacturing back to the U.S. is just too many other factors for it. Just like I think those that otherwise would manufacture in the U.S., I don't think the GILTI tax is going to drive a lot of decisions to suddenly move the manufacturing.
Well, that's the
outside of
thing,
Europe.
they were banking on the GILTI and the BEAT and the lower rates
yeah.
and the participation exemption. All of that taken together, I think they felt that would be enough. The aggregate would be enough to get people to do that, but I don't think so.